What is depreciation? Depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. It reflects the wear and tear, obsolescence, or usage of tangible fixed assets like machinery, buildings, and equipment. Key concepts under Indian Accounting Standard 16, property, plant and equipment. Depreciable amount is equals to cost of the asset minus residual value. This amount is allocated over the asset's useful life. Useful life, the period over which an asset is expected to be used or the number of units expected to be produced. Residual value, the estimated amount that will be recovered at the end of the asset's useful life. Recognition of depreciation. Depreciation is recognized as an expense in the profit and loss account. It begins when the asset is available for use, not necessarily when it starts operating. Review requirements. Useful life and residual value must be reviewed at least annually. Any change is treated as a change in accounting estimate. Methods of depreciation under Indian Accounting Standard 16. 1. Straight line method, SLM. 2. Written down value method, WDV. 3. Units of production method and other systematic methods depending on the asset's usage pattern. In this video, we will discuss first two methods. Third method will be discussed in another video. Straight line method. Under the straight line method, the asset is depreciated by charging a fixed and equal amount every year over its useful life. Its formula is cost of asset minus residual value divided by useful life, in years. Key features. Simple and easy to apply. Suitable for assets that provide equal utility over time. Annual depreciation remains constant. Asset's book value becomes equal to residual value at the end of its useful life. For example, an asset purchased for 1 lakh has residual value 10,000. Useful life is 5 years. Annual depreciation will be 1 lakh minus 10,000 divided by 5. Every year, 18,000 rupees will be charged as depreciation. Effective depreciation in financial statements. In profit and loss account, depreciation is shown as an expense. In balance sheet, the asset's book value is reduced every year by the depreciation amount. Let's solve a question. On April 1, 2020, a company purchased machinery for 2,50,000. The estimated useful life of the machine is 5 years, and its residual value is 25,000 rupees. Prepare the amount of annual depreciation using the straight line method and the machinery account for the first 2 years. Here is the solution. Annual depreciation is equals to cost minus residual value, divided by useful life. So, 45,000 rupees will be charged every year as depreciation. Let's prepare machinery account for first 2 years. In debit side, the purchase of the asset is shown as to bank 2,50,000. And in credit side, depreciation is charged 45,000. The balance amount 2,05,000 is written below, which is again carried down to 1st April of next year. In debit side, again depreciation is charged with the same amount, 45,000. The balance amount is 1,60,000. This is how a machinery account is prepared. Let's discuss the second method. In the written down value method, depreciation is charged at a fixed percentage on the book value, opening balance, of the asset each year. Since depreciation is calculated on a reducing balance, the amount of depreciation keeps decreasing every year. Key features. Depreciation is calculated on the book value. The depreciation amount reduces each year. More suitable for assets that lose more value in initial years. Assets' value never becomes zero, unless disposed. Accepted under Companies Act and Indian Accounting Standard 16. Let's look at the formula. Depreciation is equals to book value at beginning of year is multiplied by the rate of depreciation. Let's solve a question. A company purchases machinery on April 1, 2020, for 2 lakh. The depreciation is to be charged at the rate 10% on WDV method. Prepare the machinery account and calculate depreciation for 3 years. Year 1. Book value is 2 lakh. Depreciation is calculated at 10%, that is, 20,000. Closing book value will be 2 lakh minus 20,000, that is, 1,80,000. Year 2. In this year, book value will be 1,80,000. Depreciation amount will be 18,000. And closing book value will be 1,62,000. Year 3. Here book value will be 1,62,000. Depreciation will be 16,200 and closing book value will be 1,45,000. In this method, the machinery account will be prepared in the same way as prepared in straight line method, but the difference is, depreciation is charged on a reducing balance every year. As you can see, in first table, firstly it was charged on 2 lakh, then next year it was charged on 1,80,000, and then lastly it was charged on 1,62,000. This way amount of depreciation keeps on decreasing every year.